Welcome, everyone, to this Legal Office Hours. Today's topic, employee issues and non-competes when buying a business. My name is Will Smith. I'm the host of the podcast Acquiring Minds and a partner in Minds Capital, a fund that invests in independent sponsors. Attorneys James David Williams and Bill Barlow are going to host this session. James David and Bill are partners in Barlow and Williams, a practice that specializes in small business M&A. They're at the front lines of the market. Their focus is helping searchers and sponsors like you do your deals. They also represent sellers, so they see both sides of the transactions in this market. The way we run these is that Bill and James David have a presentation to give, which they'll do, and then we'll have Q&A at the end. Feel free to ask questions as we go. You look for the Q&A function of Zoom, so we don't use chat. Use that Q&A button, put your questions in, and we will collect them as we go and ask them at the end. If you have a very involved question, sometimes those are hard to do live, but ask it anyway because James David does a bang-up job of answering questions after the fact if we don't get to them in the Q&A of the webinar live. So particularly if you have a in the weeds or a live deal and there's a question related to that, ask. And if we can't get to it here, you'll hear from James David afterwards. We're recording the session. As always, you'll receive a link to the recording by email in the next day, call it, as well as a link to the slides that Bill and James David are going to present now. But just before that, I've put links to James David and Bill's contact information, their email addresses in LinkedIn there in the chat. So connect with them there. Guys, over to you.
All right. Thanks so much, Will. It's great to be on here again. So today, we are going to be talking about employment issues, and specifically, we're going to talk about basically what you should be thinking about as you're looking at a potential business, and then also when you're dealing with the employees of the business, both before the closing and also after the closing. We're going to talk about compensation, equity, benefits, all these sorts of things. Before we do that, just a little bit of extra background on us. We are a flat fee M&A law firm, and we do work very regularly in this space with both buyers and sellers. And we are happy to have conversations and to work with you as you're looking to potentially acquire a business. All right.
I'll also add, if you do use the Q&A function, make sure you're signed in to Zoom or add your email to the question, because if it's anonymous, I can't send you an email later. But with that, we'll start the presentation. So, long list of things that we're going to talk about with employee diligence. But before we get into that, perhaps we'll start by framing when this takes place. All right, so in all likelihood, you've gotten a little bit of a summary. Sometimes people will put an org chart in a sim. Sometimes they'll often lay out what the owner does and what the seller does, what role the seller and or the seller's family fills. But you're not going to get a lot of this information until you're under LOI, right? So don't expect to be able to do a lot of this diligence pre-LOI. This is really post-LOI diligence, and often, frankly, it comes after financial diligence, right? We tend to want legal diligence to kind of lag financial diligence, given our experience that financial diligence is the graveyard of small business acquisitions. And that's just where most deals die if they're going to.
I'll also just jump in here, though, just to say sometimes there is an employee issue that is so important that you actually want to front it, especially if you have a key employee in the business, like a key salesperson. Maybe it's the son who's going to stay in the business. Like sometimes there's an issue that is important enough that if you don't figure it out, then the deal itself doesn't make sense. And there, you probably want to make sure that you and the seller are on the same page, and that employee, you met with them, you're on the same page before you like go out of pocket with a lot of other expenses.
Yeah, and the same could be true if you've got union contracts or something that we'd like to front too. But at a summary level, right, you want the organization chart of the business. You want to know from the seller, and this can have, I mean, I've seen them that only have one level, or it's a completely flat org chart. I've seen them have 3 or 4 levels. There's variation here. It depends on the nature of the business that you're buying. But you want to see how the organization is structured, kind of who reports to whom, how many people are in which department, that sort of thing, right? Some of that isn't purely legal diligence, but it's to help give you a sense operationally of how the business works today. Some of that also includes a little bit more. So we've got the org chart, which is usually a 1-page kind of document or chart, right? Boxes, lines. Key employees, sort of a separate piece, often a salesperson or a head of operation, head of sales, head of operations, general manager type roles. I look for those kind of keywords. And then you also want to get a sense of their compensation, right, for employees. And this, we usually want this in like a table format. It doesn't have to be. We'd like to see employment contracts if they exist. Employment contracts don't always exist. There aren't always written employment agreements, especially in at-will states. So that's okay. That's a normal thing. People ask that sometimes. But we do want to know what the compensation is, right? Are people, on salary? Are people on commission? Are people paid hourly? Right? Are they full-time? Are they part-time? These sorts of things matter a lot, and especially if something like overtime, right? If people are overtime eligible or not, can be a huge deal because unpaid overtime comes with some pretty onerous penalties. So that's why there can be follow-up diligence questions, but initially we just want to get a sense of what the lay of the land is. It also, if you know what people's salaries are, you can, perhaps predict a little bit better what your payroll costs are going to be going forward. Because if the seller has been paying below market, below market rates for employees, then it increases the likelihood that you're going to get some knocks at the door after closing from employees looking to improve their compensation. You may even want to do it. You may even plan to do it, right? And just build that into your model.
And I think 2 other points on this when it comes to employee diligence. Number one is that payroll liabilities or payroll tax liabilities are one of the liabilities that can still transfer after basically to you in an asset purchase. And so you want to be careful about making sure that those were done correctly. The other thing I would just mention is a lot of times, not a lot of times, but occasionally, we will have a situation where the employees were not, maybe there was people that were independent contractors that really should have been W-2 employees, that type of stuff. And, you are definitely going to need to do the right thing going forward. It's a little bit of a judgment call whether you're willing to accept the risk of the fact that the seller didn't properly classify going backwards. But going forwards, you're definitely going to need to do it the right way. And you have to build that also into your model, right? And so those are just kind of things to keep in mind as you're kind of going through the diligence process.
And so that's kind of more the specific issues. And then there are more kind of programmatic or global issues with employment stuff, right? You want to know what their benefits are, right? What's the healthcare plan? What's the 401k? Is there a 401k? Do people get dental insurance and eye care insurance, right? Does somebody get a car allowance for some reason, right? You want to know these things. because things like a 401k and an asset purchase, right, you'll be creating a new one, but you want that to be a seamless thing for your employees. Right? So you've got to get it set up in advance, get everything transitioned properly, right? Because you do not want friction for your new employees.
And I'll also just say, I remember one thing, it was a deal that closed about 2 months ago, where there was a conversation with one of the employees, and they were a key employee. And one of the funny negotiating points was their vehicle allowance. Like they were asking for a truly outrageous amount of payment for a really deluxe car, and they wanted like a car wash, $150 car wash, monthly car wash plan. Like they were like all into this. So, you might not think of this as a major item, but you'd be surprised how much, employees can end up caring about things like this.
Yeah, and you also want to, look at things like the employee handbook, right? And get a sense of if there is one, there's not always. And then I've looked at a couple recently where people didn't actually fill them out. They left the placeholder brackets in the document. But you want to see the employee handbook, right? Do they have policies on, discrimination, harassment, that sort of thing, right? You definitely want these going forward. There's kind of standard templated documents, but if there's something weird, or if there's something weird about how people do vacation, you want to know that. You also want to know, right? PTO, you policies, whether that's vacation, sick leave, however it's construed. But do those things accrue? Are they use it or lose it each year? Right? Is there rollover? Some of these things are liabilities. PTO is actually one of those things that becomes money at the end of a deal. People don't always think about it on the front end, but it's a liability on the balance sheet, right? So it ultimately will usually gets handled through working capital discussions. Commissions and bonuses are the same way. Like we have a couple of at least one transaction where they're targeting a close at the end of this month, right? And the company always does an annual end of year bonus, right? And it's a fixed amount relative to their salary, so we know exactly what the amount is going to be. So in that transaction, they've decided to split it, and the seller pays 3/4, the buyer pays 1/4 based on the calendar year, right? So these are the sorts of things that you need to find out about first before you can negotiate them later. And then another point that is perhaps more relevant in this time than it would have been a couple of years ago, but that's work authorization status for employees. A lot of these small businesses are not part of the E-Verify program, and so they'll need to have I-9 documentation, right? It's a form in a, if it's done fully correctly, they'll also have a copy of the supporting documentation, whether that's a passport, a scan of the front page of a passport or a social security card. But often we just see the documents themselves. Here's the I-9 itself. We don't have the supporting docs. So, it's a little bit scary when that's the case, but you kind of, we're here to assess risk, not kill things. Anything else, Bill, as far as general diligence items for employees?
No, I think that basically covers it. The next thing we'll talk about is employee compensation, and the first thing we'll talk about is equity compensation. So this is something that honestly is usually more of a big deal when you're talking about startups and that type of stuff. So we're gonna gloss over a little bit of this, but some of this can still really be important to you, because you as a searcher, you might say, hey, I like this employee, I want to give them I want to give them equity in the company. Right. And that's might be a great impulse, but when you're actually giving them equity in the company, there's a lot more considerations you need to think about. So I'll just give you an example. Let's say you just bought a company for $5 million, and you really like one of the employees and you want to give them 2% of the equity of the company. Well, if you were to just do that and just go to the employee day one and say, congratulations, I like you, you now own 2% of the equity of the company. Well, from a tax perspective, that's treated 2% of 5 million is $100,000. The IRS treats that as if you just handed that employee a $100,000 check, right? And will tax the employee accordingly. So the employee might not know that, might not want that tax result, probably, wouldn't think to file that on his tax returns, which means he might, have penalties later on or other things. So there are a lot of complications from a tax perspective when you want to give somebody that. So that's why sometimes what you do is what's called profits interest. You basically give them, it's kind of like options. If you've heard about them, you have the right to sort of the future profits of the company, going forward. Like, so as it grows above 5 million, they would have some profits interest in that. But that avoids a lot of the tax issues. In order to do that, you have to do something called a 409A. That's to make sure that it's valued correctly. And then usually you don't want to just give them equity, right? Like even if you have an employee, you step in and you day one, you really like this employee, if you just give them whatever percentage of the company, you might not like it if, 1 week later they decide they don't like you anymore, they walk away, and then they just own 2% of the company in perpetuity, right? It's usually not a very good result for you. So instead, what you typically do is something like vesting, which says like, hey, you are going to get this equity, but you'll get, a quarter of it every year for the next 4 years. And then, then you'll be fully vested. So if you keep working here for 4 years, then you get it, right? If you do that, they have to do something called an 83B filing. There's very strict filing deadlines for that. And you also, if you are going to give equity to employees, you have to think about what happens if they leave. What repurchase options are you going to have? And frankly, the employee probably wants this too, if they think about it. Like if they've left the company, they might not want this stray interest that they have no control over. So it's like, okay, well, if you leave the company, how can I buy you out? How can you be bought out in a way that's fair so that, both sides are happy, but we can both kind of walk away is sort of the idea. And again, these are all conversations you can have, but just beware that if you give equity, that's especially tricky, and you definitely need to get attorneys involved.
And it looks differently depending on your entity tax structure also. There's multiple layers of complications with this. But Bill gave a nice simple summary. So that last slide was something that happens sometimes. This slide is something that happens every time. At least every time you have employees. You can expect within the first few weeks to get a knock at the door, whether that's a physical door or a metaphorical door. And you're going to have employees ask for something. Right? Probably a raise, maybe more, could be that car allowance that Bill talked about. Could be a little bit of vacation, could be something else, right? But it's going to be more money usually. I can't say I've had that conversation myself, right? I've not bought a business. I've built one, but you need to have a plan for this conversation at the very least. And it may be that you come in day one and just announce, right, we're going to keep compensation exactly the way it was as a review, and we're going to do a thorough review process for the next 3 months or whatever time frame. Now, even if you do that, still expect the conversation, right? Still expect them to ask, because they don't really have anything to lose, right? They're testing you. You're the new boss. You got to prove that you're the boss. And it may be that you've decided, that you're doing raises, right, across the board. And And if you are, right, great, announce it. But just have a plan.
And this is also where retention bonuses can really be your friend, because sometimes, you are new and you might not know if this employee is actually a really good, well-performing employee, so you don't want to make them angry if they are a really good employee, but you also don't necessarily want to lock yourself into this permanent higher compensation structure if, they're maybe being paid above market and maybe they're not as strong. So that's where retention bonuses can be great, because it's like, look, 6 months from now, if you're still around, I'm going to give you this extra bit of cash. It's like this good faith way of saying like, hey, I appreciate you. I appreciate what you've done. I believe you, but just give me a little time to assess it, right? And then at the end of that 6 month period, then you might have a little bit better of a sense. You'll have your sea legs on and be like, is this somebody that I want to keep around, or is this somebody that is not really as much of an asset to the company as they might be, you might have thought initially. So don't have to do it, but just something to keep in mind as an alternative.
I'll also add here, sometimes sellers will give notes on employees. They'll give kind of paragraph summaries. I've seen this, or even just in conversation, tell you about people. Take those summaries with a grain of salt. Sometimes they're accurate, but sometimes your true top performers are not the people that the seller thinks are the top performers. I've seen that more than once where we've talked to somebody a few months later. It's like, yeah, had to fire all these, right? Had to get rid of the people that the seller had said were the top employers and promote these other people that the seller was bashing. So you think you'll know, but you won't know. And that's why we kind of want to, you want to put a freeze in place for a little while if you can to assess. Because the only thing you know is that there are things you don't know.
I'll tell you another story. There was one person who bought some type of construction business. I'm not sure if it was roofing or landscaping or something like that, but there was one employee that was not on his radar as a key employee, but just knew all the technical answers to the questions that would pop up. And, they were talking and talking about the experience afterwards. And they're like, I didn't know that they were important, but once I got into the business, I realized like this person is vital because without this person, I have no way of answering all of these questions. And so, you might not know, there might be a critical person that you don't even know about, but actually is like the glue that or filling some very necessary function that nobody else can function, and you actually need to make sure that you're keeping them very happy. So just keep in mind, you might not know who your key employee is, like even as you're stepping in.
Yeah. And then I'll just address this last bullet of PTO a little bit here. So normally, right, you will want to assume PTO and then just let that carry over. Because employees might not like it if they get cashed out because they could have had a big vacation planned right after closing, because they're not going to know closing is going to happen anyway. So most of the time you'll take that on as a liability kind of, and then you adjust the purchase price accordingly. It doesn't have to be that way. Sometimes you do pay it all out and start with a clean slate, but usually people want to roll it over. And then that's a sort of thing where you probably keep it the same as a policy initially, but as you do policy reviews, that's one of the things that employees can really care about.
Non-compete agreements, everybody's favorite. So the non-competes, they're a little different from non-solicits, which we'll talk about in just a moment. But non-competes basically says you cannot compete or operate in this field, and you kind of specify what it is within this region for this area of time. And these are very common with the seller. So obviously, if somebody's selling you a business You don't want them right after they sell the business to pop up and start, business number two, that just takes, everything away from you, right? But here we're talking about it not with respect to the seller really, but really with respect to the other employees. This can be really sensitive to employees, especially if they've never signed a non-compete before. Sometimes they're really skittish. The other thing to know about non-competes is that it's very variable by state. And we put up 3 examples here just to give you a sense of how different it can be. Like California, employee non-compete's just not enforceable. Like it's just out. Which can be a problem if your chief sales guy decides to leave after day 2 and, what are you going to do about that? Florida, like up to 4 years if the employee earns twice the county median wage. Washington, only if you make, slightly more than $123,000 a year. So like the point is that all of these states have very different rules, and you're just going to have to navigate it on a state-by-state basis when you're kind of deciding how you're gonna approach this.
Yeah, and a few more notes here. So, I mean, for one, the Florida legislation, they passed a new law that went into effect July 1. So that's a new thing in the last few months. So these things do change, right? The national trend is against non-competes to make non-competes harder to enforce. But that's not universal, right? Look at Florida. Also, there needs to be consideration for these, right? So if you want an employee to sign a non-compete, you need to pay them for it, or it needs to be part of their original employment agreement, right? If you can't just do it later and not, right? If you do it later, you need to pay them at the time they do it later, right? It's in a lot of states. Again, not universal, but in a lot of states, continued employment is not sufficient consideration for a non-compete, right? So you need to, if you're going to do this, plan to do it initially, right? As part of the hiring process, the onboarding process. Otherwise, you need to pay people $500 or whatever at the time they sign it in order for it to be enforceable. And that's, one of those things where, given the national trend is against non-competes, that sort of thing can matter in the end. And one more note before we move on from this slide. Right, this is what we've been talking about is only for employees. This is not for the seller, right? Anyone who is a seller of a business, no matter where they are, even California, right? A non-compete is enforceable.
And this goes to the next thing, which is honestly a lot of what you really care about. You might think you care about a non-compete, but actually a lot of times what you care about is what's called a non-solicit. So basically that can prohibit employees from leaving and then soliciting the customers, which is the most important, or soliciting other employees to work for a competitive business or do business with a competitive business. So usually the thing that's most sensitive is, hey, I don't want my key sales rep to, exit 2 days after closing and take a bunch of key customers with him, right? Well, even if you're in California and you have you can't really do a non-compete, you could still potentially do non-solicits, which is saying like, hey, if you leave, you can't go and talk to the other customers, and kind of do something like that. So, just so in general, this is a lot less scary for most employees because most of the time they're more worried about being able to continue to have a job within their area of expertise. And this also gives you a lot of the kind of meaty protections that you need. So non-solicits are really where a lot of this is, and make sure you do have really strong non-solicits. Regardless of where you're at.
And you can have non-solicits for sellers too.
Yeah. And that's very common.
Okay, well, that was the last of the presentation slides. So we'll be moving to the Q&A portion here in a minute. So there's a few in there. Go ahead and fill those in while we do the outro, and then will take over as moderator again. So again, we are Barlow and Williams. We're an M&A law firm. We do flat fees for all of our engagements. We work with buyers and sellers. We've done deals. We have deals right now with equity investors. We've got deals that are self-funded. We're working with some sponsors, right? We kind of see the whole panoply of structures in these markets. Our fees, we think, are reasonable, and we do them on milestone-based. We use a milestone-based structure. It's meant to align costs with progress in the transaction, and those tend to be backloaded because we know where deals tend to die, and so we want to minimize dead deal costs in the event that transactions fall apart in financial diligence. Email is on the screen there. Feel free to reach out to us if you have a live deal. We do also freely give away an LOI template that we've prepared and that we've done a webinar on before. So it should be available on the site. You can also see videos of me filling out the LOI template on live listings, or were live listings at the time, on our website, if that's helpful. But if you want that LOI template, just let us know in the Q&A, and we'll be sure to get that to you as part of the webinar follow-up. But I think we'll hand it back over to Will and do some questions.
Great. Thanks, James David. Thanks, Bill. Great presentation, as always, and a lot of questions. Before we turn to them, everybody just notice in the chat that I just put live links there. For the ones you see on the screen, you can now click there. Actually, not to Barlow and Williams. I just did it to, oh yeah, no, I did. Good. To LinkedIn's and Barlow and their website. And as James David said, if you want the LOI, you can put your name in the Q&A. You can also just email the guys at their email addresses there. Okay. Yeah, a lot of questions. Let's start with Stephen asks, can you ask about the ages of every employee to understand the risk of long-standing employees who may be approaching retirement? And yeah, and just to have that be part of your calculus, maybe this employee will use the acquisition as an opportunity to go ahead and retire. Or is this somehow violating discrimination stuff or something like that?
We don't usually ask for it. And I mean, you're right to consider it an issue. It will, or a possible issue. It will come up in conversation sometimes. We do ask for the tenure of the employees as part of the normal course. So if you see a tenure of a certain number of years, you can make certain assumptions about that. We have one right now where that's live, where several of the people, I think the majority of the employees have been there 20 plus years, right? So this is definitely a live issue for those buyers, for that buyer. But asking age is not something that we've done. So
I've seen when we're sell side, I think I've seen one time where they've asked for age. So it's not legally prohibited. It is prohibited to discriminate. So you can't just decide, for instance, oh, I'm not gonna give job offers to these guys because they're going up in age or whatever. But if you want to ask that, you can. But as James David said, usually tenure is really going to get you, the information you care about.
I-9s and the legality of workers. James David, you glanced off the obvious that this is in the news constantly and an issue affecting many people, many owners, many would-be owners, many employees. Anything to say about what you're seeing anything from the front lines of this market of what you guys are seeing? Is this affecting acquisitions in any way?
It's certainly more of an issue in certain certain
Sure.
geographies and certain industries. I'll say that. Are we seeing it? I've not seen, we've not had a deal die because of this. I've heard stories about it, but that was even before this administration. So, landscaping is one that's notorious.
Sure.
Um,
I think two thoughts. One, I think we've seen an uptick in just compliance generally, that people are actually providing these. And then two, and I'm not going to say this is good, bad, one way or another, but in a lot of industries where they're building, construction, that type of stuff, a lot of times they end up having subcontractors. And those subcontractors are the people that are potentially hiring people without, the proper authorization, et cetera, et cetera. So, you want to know, if your company is actually hiring subcontractors, right? Like what are the practices? What are we doing here? What's the stuff? Because, again, you very well might not be comfortable walking into a situation if you know that that's if they're basically just hiring illegal workers with cash, right? That might not be a practice you're willing to undertake going forward. And if you're not willing to do that, then maybe the financials don't make sense of the business, in the same way.
Great. Guys, could you go back to the slide around equity grants and so on and profit interest? Great. There were a bunch of questions off this slide. First of all, when you say profit interests versus profit sharing, same?
So usually profit sharing agreements, and they can be formal or informal, but they say at the end of the year, based on how well we do, we're just going to give you some amount of the money, right? That's very different from what's called a profits interest. Profits interest is a technical term, at least how we're using it right now, which basically acts like an option, but for limited liability companies. So let's say that you have 1 million units in your company and the company is worth $1 million. Then right now it's $1 per unit. A profits interest could say, hey, you have the right to buy one share of the company or one unit of the company for $1 going forward. And so if the company goes in value from $1 million to $2 million, then that, right essentially becomes worth an additional $1 from being kind of worthless. So that's what a profits interest is. It's a much more technical term. Profit sharing takes another agreement. But you also have to be really, really careful if you're doing profit sharing agreements, that you're not this isn't like an in perpetuity thing, right? Again, this is why sometimes I think bonus structures where you're basically giving discretionary bonuses that might be kind of based on how profitable you're doing is in general better for the company than formally writing out you have the right to 5% of the profits of the company. You know what I mean? So just be really careful, because you don't want to end up in a litigation where an employee says I have the right to 5% of the profits of the company.
Yeah. Phantom equity. Did you guys touch on it today?
no, we didn't, because I don't love it. Phantom equity is a contractual right to money if certain events take place, right? It's purely a contract. So some of the tax treatment is worse for employees than some of these other options. Some of the, when it is triggered, right, it's phantom equity is by contract. So it could be triggered by only a stock sale, not an asset sale. It could be triggered, right? It could just go away when you leave with no compensation, right? There's a lot more potential variables, potentially less complexity from a tax perspective, but phantom equity, right? As it says, it's phantom. It's not real equity, right? It is purely a contractual agreement between the company and the employee.
Why don't you like it, James David?
Um, because I've seen it used to screw employees on
How would somebody screw employees?
multiple,
Because
like,
with all these little qualifications,
yeah,
they
the qualifications, or okay, well, this would trigger if you're still employed, so we're gonna fire you the day before. Or, it's gotta be a stock sale to trigger. Well, we're doing an asset sale. Sorry, you get nothing. Or we go through a corporate restructure to completely change something internally, and now your thing is nothing. I've seen it, yeah. And so I don't love it uh, in most contexts. I mean, that said, I have done it with one that's supposed to be signing today. So we'll
Hmm.
see. Hopefully, it's going to close today, where we did a phantom equity agreement right at the very end as a way to get an employee, just kind of promised cash as part of a deal. So
It's a tool in the toolkit, but one which, is often not employee friendly, and you just have to keep that in mind as you're deciding to employ it.
and this point that it's a contract, the implication of that means it's only as good as how well that contract is written, and there kind of are no rules. It's kind of like whatever. Yeah, that's the implication.
yes,
And another implication of it is you're not getting long-term capital gains on it. So if you had equity and you then sold the equity that you held for more than a year, you're paying long-term capital gains, which is a much lower rate. If, on the other hand, you had phantom equity, you're paying short-term income. And that could be, basically going from a 15% tax to a 35% tax. So it's a big difference for the employee. We're not saying that you never do it, we never help people with it, but like you kind of need to know that, what the implications are.
And question on these tax implications directly. So you gave the example of if you were to give when you give equity to an employee, when you grant equity to an employee, it's a taxable event. It's because you're effectively giving them a monetary value, and it's a transaction of sorts, and the government taxes that. Is granting phantom equity?
no,
No.
It's not in that moment, only if the
it's
triggering event occurs. Go
yeah,
ahead. Yeah.
it's the grant of phantom equity is not a taxable event.
Yeah. It is less complex to do phantom equity, and that's one of the other reasons people like it. Because you don't have to do all this stuff.
And then the reason you do an 83B election, and it's called that because it's 83B in the tax code, is if you're vesting, you give somebody vesting equity that vests over time, or even profits interest that vests over time, you still want to do this. So as a technical matter, right, each tranche, right, would be a separate transaction. And the employee would need to pay taxes at that point, and potentially the valuation has gone up as we're doing this, and it's just overly complex and what have you. So the 83B election allows you to tell the IRS is I've been granted these units, this stock now. It's subject to restrictions over a period of time, but I want to be taxed on it now. Right. And at that point, right, the tax is paid, and then you can move forward. So that's what the 83B is, but it has to be done it has to be submitted within 30 days of the grant, and there is basically no extension for that. So
yeah, very, very strict. And we've seen people on the back end that fail to make that 83B election and then get like really quite damaged from a tax perspective. So we have a client, we have actually a set of clients right now that are filing 83Bs this week. And so it's something that when it's important, it's very, very, very important.
Do profit interests typically earn any share of the exit value of the company? If
Yes.
so,
Yeah.
yes. Okay.
So
And then there's a
profits
follow-up.
interest Profits interest basically sets a floor, right? So we've got an LLC, it's worth 5 million now. We give you profits interest now. All right, so you would get a percentage of the amount above that. You don't get anything of the first 5, but if we sell for 10, then you get a percentage of that second 5.
Yeah. So it can go to 0 if you, like, let's say it doesn't sell for 10, it sells for 5 or below, then your profits interest is going to be, effectively not worth anything.
And so if you think about that compared to stock options, which is just the same way stock options work, or that same dynamic that stock needs to go up for it to be worth your while to exercise said options. Is the only difference there basically we're talking one is LLC land and one is C Corp land?
Yeah, exactly.
Yeah,
And what about governance rights?
that's one of the reasons you do this. Profits interests, or they get economic rights, but not governance rights, where they can. You can structure it however you want. Caveat S corps, um, but yeah, I mean the profits interests. I mean they can be structured to allow distributions along the way too, right? Which a stock option wouldn't get unless it was exercised. But
Yeah.
but the profits interest could allow for distributions during the whole period also in a way that a stock option really doesn't until you exercise that option. So they're not exactly the same.
Yeah.
Right. This is going back some to, well, so the question is the scope of legal work that we're talking about here, like employment stuff. So the questioner asks, the buyer would need to hire a lawyer who specializes in employment and not rely solely on an attorney who specializes in M&A, or all of this stuff, all of this documentation for the legal contracts for employees and owners and stuff, that all can be handled by the M&A attorneys.
So the way we handle it, which may not be how everybody does it, right? Large law firms have their specialists. We have the two of us. So we would do all of this, right? The only part we don't do, we work with a specialist counsel if there's a collective bargaining agreement, right? So union contracts, we work with people on that. Otherwise, we're doing all of this. If it does turn out that we need a specialist in a particular jurisdiction, then we'll find that person.
Yeah. We've done 2 deals recently that were union deals. The other thing is, this is pretty rare, but if they ever did have like a certain type of ERISA benefits, that type of stuff. Usually you actually only see that happen in connection with unions because often they pay into an ERISA plan, but the union takes care of it. But if, again, very rare, but if they had some type of program like that, then you really have to dig down and do a really deep analysis. Something that hopefully none of the searchers, are going to have to deal with.
Are there any standard terms that are used for retention bonuses, say 6 months or percentage of salary?
No, not really. I mean, 6 months, 12 months is 6 months is probably more typical. And then amounts, I've seen anything from a flat amount for across the board to a percentage of salary. But some of it also depends on what time of year the acquisition happens, right? If people are used to getting a bonus in December, then maybe it's going to end up in December, whether you did the acquisition in April or July. So I don't know that there are kind of hard and fast rules for any of that.
Yeah.
What about best practices around to whom it's offered? Offered to everyone, just key managers?
It
I
really
guess
kind
it
of
depends.
depends on,
The key person, I guess, key people.
yeah, it just kind of depends on the structure, right? Because you don't want people getting jealous of each other, but also, in a lot of companies, there's a kind of clear delineation between management and hourly employees. And so I would just say, this is something that's a little bit more art than science, in terms of figuring out like who you would want to give this bonus to, and how do you make sure that, somebody doesn't feel left out like that.
Just assume that people will talk.
Yeah, exactly. Assume everybody knows everything, everybody else's comp.
Hmm.
That might not be true, but it's embarrassing if you assume the opposite and then they talk.
Is unvested equity for employees usually rolled over into the new ownership structure?
Typically speaking, with vesting, you get an acceleration once there's an actual deal. I mean, it doesn't have to technically happen, but that's how it's supposed to happen. And that's the market practice. Do they get rolled over? Well, usually this is very much a matter of discussion. So if you're in SBA land, probably not, because, well, if you're in SBA land, it's sort of an issue because then you have to fire them unless you're rolling them because they have to be out because they're an owner, right? So that can get complicated. But in most deals outside of the SBA, you usually just look at each employee and say, do I like this person or do I not like this person? And then if you're not sure, maybe you just kind of cash them out. But sometimes you really like this person and you have them roll that equity and they get equity in the new company and then even potential additional upside. So, just keep in mind though, that is a very heavily negotiated point with each of the employees because, they might, if they're rolling equity, they might say like, well, I want all the benefit of the leverage you're putting on this company, right? Which means that maybe their equity stake actually doubles if levering it up by 50%. So
A lot of employees aren't going to be that sophisticated, but
that's true.
it's also right if you're doing an asset purchase, right? Probably not even possible in a true sense to do a roll, right? Because you're setting up a new entity. And then it would depend on whether they have single trigger vesting, double trigger vesting, no vest, or single trigger acceleration, double trigger acceleration, no acceleration. Those are startup terms. Fortunately, I don't have to deal with as much anymore because we don't do as much work with startups. But
Good old days. Good old days.
If implementing a non-compete for a remote employee, the applicable law is where they are, the state where they are,
almost
or
certainly,
what?
yes. Almost certainly going to be where they are.
Okay.
That also
Okay.
means if you're, doing a foreign employee, you should probably just assume that your ability to enforce things is going to be limited depending on the jurisdiction. And by
And
limited,
that's being kind. I would say non-existent.
Non-existent. Yeah, good luck trying to, go to the Philippines and force them to, enforce some of this stuff. So
Is there a specific size or employee base where engaging you guys formally makes more sense? So if the deal has more than 5 employees or 10 employees or something like that, I guess the real question is, at what point is a deal too small for it to make sense to
I mean,
engage you?
we have deals right now with no employees. And then we have deals that have 30, 40, 50 employees. It really depends on the industry. There, in theory, there's a size where it doesn't make sense to use this anymore, but it's not often based on number of employees. It will be based on something else.
yeah, like the purchase price or something. right? If you're buying a company for $100,000, I mean, query whether that's a good company to buy, because usually you're buying a job, but you know, we're probably like cost prohibitive for stuff like that, right? Um,
And do you have a threshold for what that number would be?
You know, we say to reach out, and one of the reasons we say that is because if it's below our threshold, we'll give you recommendations for people that are, you know, closer to your buy box, or we'll do that, and we're happy to pass those along. So I would just say reach out to us regardless, and worst case, we'll give you a good recommendation for an attorney that is, you know, kind of a little bit more within the box.
Great. Stephen asks, can you clarify again your earlier point on how to model PTO into the financial model? You said something about payouts and liabilities. And then he says, I was not aware you needed to pay out PTO days when business ownership changes.
So again, there's some variation state by state, but accrued vacation is a liability on the balance sheet, right? Because that's money that has to be paid out to the employees. When if you're doing a stock sale or a stock purchase, then this is less of an issue. But in an asset purchase, as a technical matter, right, the seller fires all of the employees and you rehire them immediately, right, as a technical thing. And since they're being fired, right, that means that all unpaid benefits to them have to be paid, you know, at that point under state law, right, which would include accrued vacation or sick days or what have you, right? So that's kind of how that works. But often what you want to do is just carry that forward. So you'll just credit that on right? You will credit those days of PTO for your new company. And because the seller didn't have to pay that money, right? You're taking on that obligation because those PTO days have a monetary value based on, you know, the employee's salaries or hourly rates. The purchase price gets reduced accordingly.
And so this is standard. This is the best practice, how to handle this.
This is how it's done most of the time. Sometimes
That was
people
great.
just pay it out, but it can be tens of thousands of dollars that we're talking about. So,
And this is one of the
even
things that's
more.
often missed when people are thinking about net working capital calculations and indebtedness. This is often counted, it depends actually. Sometimes people count it as a debt-like item, which is interesting. But anyway.
For the transition period, is it legal for the seller to work for no compensation, or is that illegal?
Yes, you
yes.
can do it. You can have a certain amount of, the way that you do it is to have transition services included in the purchase agreement, right? So that as part of the purchase, you're purchasing a certain amount of transition services, basically.
Yeah. So it is for compensation in the eyes of the law because they were just paid that whole purchase price and they just have to do that as part of it. It's not like hourly compensation, but it's just, you know, part of the deal.
The FTC tried unsuccessfully to eliminate non-competes. James David, I guess you hinted at this earlier. Tried unsuccessfully to eliminate non-competes. Do you know if there are actions underway to try to push this through?
So FTC, federal level, change of administration, change of policy. So it's not a priority in the present administration. At the state level, which is what we've talked about, and since there is no federal policy on this, it defaults to the states. At the state level, the trend continues to be against non-competes, but there are a few exceptions, which is why we put Florida in here, because Florida, as of July 1, passed a law that is more employer friendly relative to non-competes. but that is not the national trend. And again, every state is slightly different on these. We just picked these three as examples.
Great. We'll do one more question. You guys, James, David, you have a few more. You'll answer separately, but not a ton. A lot of people are interested in the LOI template, which is what a lot of these questions are, is their email addresses. So final question, then we'll wrap. How do you recommend approaching diligence when a key employee who will stay post-acquisition is a family member of the seller? Are there specific legal protections or deal terms you advise in such a scenario?
Approach it very carefully. That's the short answer. What you can do, right, depends a little bit on things like what state you're in because of enforcement of non-competes, right? The slide on the screen. But also, were they owner, right? Did they have an ownership stake prior to the transaction? Because that it can impact things. Because if it's a selling owner, right, and there can be SBA complications to this, but if it's a selling owner, then that you can put more restrictions on. Or are you going to have them, get equity post acquisition, right? Because if someone is a member of an LLC or a shareholder of a corporation, they can sign up for all these things, right? Non-compete, non-solicit, non-disparagement, what have you, as part of the operating agreement or the shareholder agreement, right? So you can bind people that way. So there are mechanisms that work in certain situations to address those concerns, but you do have to be more careful if a key employee is a family member, right? Because just have the reality of somebody who knows a lot about this business just had a family member get a whole lot of money, right? And and okay, well, dad got a lot of money. Well, let's help son start his own. If that is the plan from the sellers, they're obviously not going to tell you that. I would expect that you can get a sense, though, right? As we always say, if you get even the slightest inkling that you are not interacting with a high integrity individual as a seller, you need to run. Don't walk, run from the deal. And this is one of those, that sort of scenario is one of the ways that could manifest itself if you aren't dealing with a high integrity seller.
One thing I'll just also add is that sometimes people ask us like, hey, can I just include no family members will start a business in the non-compete in the purchase agreement? And the answer is not really, because you can stop the seller from investing in, businesses that are competitive, but you're binding the seller to what the seller can do. If the seller's son starts a business and is not given any money by the seller and the seller doesn't help them in any way, query whether that's actually true. But if that does happen, the seller's, not going to be bound. So just keep in mind, it's not as simple as just changing the language in the non-compete with the seller. You have to be much more, you need to have the actual person you're trying to bind, i.e. that son or daughter. You need to have them have some type of signed agreement with you so that you can have something to enforce.
Yeah. Okay. Excellent. Office hours webinar, gentlemen, as always. You'll be back next month. Do we know what the topic is yet?
I don't think we've nailed that down yet. It'll be something good.
Something amazing. These webinars are always so rich. Thank you for doing it, Bill, James, David. Thank you all for your attention. Watch your inboxes for a link to the whole recording, as well as the slides. Not a link to the LOI template. For that, put your email address in. right now into the Q&A, or you can just email Bill or James David. Their email addresses are in the chat. So watch your inboxes for that, and that'll come out the next day. And I think that's it. This ends the webinar. Thank you, everyone. Bye.